This is the first of 6 videos where we debrief the tasks in the AAT's sample assessments for audit and assurance. So these are a new set of videos because AAT have revised the structure of the assessment from September 2024. So in task 1, this is about the conceptual and regulatory framework, corporate governance and internal audit. So there's a number of multiple choice and drop-down type questions in this task. So for part A, it tells us an external audit practitioner provides different levels of assurance depending on the work carried out for the client. So it could be that we provide no assurance at all, so we're just perhaps reporting some facts. It could be we provide limited assurance because we're going to be doing less work, or we're providing reasonable assurance. Now remember, reasonable assurance actually means a high level of assurance, but for legal reasons, auditors talk about reasonable because high is quite a strong term and may confuse the amount of assurance that we're actually giving. People might think that high assurance means absolute, which it doesn't. So we're told that a practitioner may conclude that nothing has come to our attention to suggest errors or problems exist when they have undertaken an assignment. And we need to identify the most likely assignment the practitioner has completed. So we can see where we're providing some sort of opinion here that nothing has come to our attention which thinks there's a problem. So we're reporting that, as far as we're concerned, there is no problem. So that is an opinion, so we are providing some assurance. So we've got the 3 possible choices here. A report on factual findings, such as a grant application. Well, no, because if we are reporting factual findings, there's no opinion provided, so there's no assurance. It could be a review of a budget or a forecast. So because that's a budget or a forecast, and that's things that's going to happen in the future, so we can't provide a high level of assurance on that. We can't give a strong opinion on future events because they haven't happened yet. So this would be limited assurance. And we would give an opinion in the format that nothing has come to our attention that causes us to believe that the budget has not been prepared on a reasonable basis. And finally, for a statutory audit, well, this is required to be reasonable assurance by law. And in this case, we'd give a much stronger opinion that the financial statements give a true and fair view. So let's just recap the 2 different types of assurance. So with reasonable assurance, we're going to give an opinion in a positive format. So we're making a very strong statement that everything's okay. The financial statements give a true and fair view. Nice, positive, clear opinion. Whereas with limited assurance, we're giving it in the negative format. And we're using 2 negative words here. So nothing has come to our attention that causes us to believe that the financial statements do not give a true and fair view. And remember, in the English language, if you have a double negative, they cancel each other out, and that gives a positive statement. So the meaning of the 2 opinions is the same, that basically everything's okay. But in the second one, because we use those double negatives, it's a bit more confusing, isn't it? And it's supposed to be, because we're giving less assurance, we're giving less confidence to the readers. So the answer in this case, if we're giving a limited assurance, that's going to be a review. Then in part B, identify which of the following statements, which of the following standards the International Auditing and Assurance Standards Board is responsible for setting. So for the International Financial Reporting Standards, well, that is created by the International Accounting Standards Board. So the IAASB does not prepare those. But they do prepare the international standards on auditing. Then in part C, complete the following statements about the auditing process. In listed entities, the reappointment of the auditors is recommended by, so let's look at the choices here, well, it's going to be by the Audit Committee. So the Audit Committee are a group of non-executive directors. So these are part-time directors. They don't really work for the company. So hopefully they are independent. And they will recommend who the auditors should be. And we don't want the directors to do this. We don't want the chairperson to do this because we don't want the directors to appoint their friends to become the auditors and to look at their own work. So we want this committee of independent people to recommend who should be the auditors. And then the recommendation is approved by, well, it should be approved, well, not by the directors. We don't want the directors to approve who's going to be examining their work. So we want the shareholders. They're the ones who we want to approve the auditors. So again, let's remind ourselves of what's going on in this audit situation. So we have the company and they're being run by the directors, but the company is being owned by the shareholders. And remember, the shareholders are putting money into the company, but the directors have control over the business, so they're spending the money. So we want to make sure that the shareholders know how the directors are spending the money. The directors are accountable to the shareholders. So they prepare the set of financial statements where they explain, this is how we've spent your money. But the trouble is, if the directors have spent the money in some sort of dodgy way, then potentially they're going to be lying in those financial statements to hide all the dodgy things they're doing. So that's why we need to appoint some auditors. And remember, those auditors are going to be working on behalf of the shareholders. So the auditors are trying to protect the shareholders from the directors. So they're going to examine those financial statements to try to verify that they're not materially misstated. So we want to make sure that the directors do not appoint those auditors. So we want to make sure that somebody who is separate from the directors are doing that. So typically in the company, they'll have two sets of directors. They'll have the executive directors, who are the people who are basically running the business. And then they'll also have the non-executive directors who are part-time and hopefully independent. So they're just overseeing those executive directors on behalf of the shareholders. Again, there's another layer of protection for the shareholders there. So yeah, we want them to recommend who the auditors are, and then for the shareholders to decide, yes, we actually approve this. Then in part D, identify whether the following statements about the auditors are true and false. So internal auditors are responsible for preparing the financial statements. Well, that's false. The directors are responsible for preparing the financial statements. Next, the internal auditors report to the external auditors. Well, that's false as well. The internal auditors are appointed by the audit committee and they report to the audit committee. Remember, the job of the internal auditors is to verify that the controls in the business are working well, and they're trying to identify if there are any problems. So again, they need to be independent. So the independent internal auditors are appointed by the independent audit committee, and they should report to that audit committee. They should not report to the directors who are responsible for running the business. Because you could imagine, couldn't you, that the directors want to hide any problems, so they may instruct the internal auditors to hide those problems. And then the third statement, the audit committee is responsible for ensuring the independence of the external auditors. Well, that's true, but also the independence of the internal auditors as well. We want to make sure that those external auditors have no connection with the directors and no connection with the business, so they're providing an independent opinion on the financial statements. And finally, in part E, complete the following statements about the roles and responsibilities of internal and external auditors. So external auditors report to, they should report to the shareholders. Because remember, in that diagram we saw just now, they are there to try and protect the shareholders and give them confidence that the accounts prepared by the directors are not materially misstated. But they can also report to the audit committee, because they're the ones who are who are trying to make sure everything's going well with the company. And then the objectives of the internal audit department is so are they adding credibility to the financial reports? Well, they do that, because if they can verify that the controls are working well, then hopefully there is more believability about those financial reports. But are they also there to evaluate and improve the effectiveness of governance, risk management and control processes? Well, in this case, both of these answers are potentially correct. So we need to decide which one of them is the better answer. And in many cases, internal audit will focus on financial reports, but really they should be focusing on more than that. So they should be looking at the control processes over everything in the business, not just the financial side. They could be looking at marketing, they could be looking at purchasing, they could be looking at human resources. So yes, their role is really to focus on the bigger aspect of governance, risk management and control, and not just on financial reports.